एरिया आहे ना
हां
तिथेच होतं फक्त
हां
तुम्हाला तिकडनं फोन करतो या
बरं. Hi, I'm Professor Ashok Patil and welcome to this course called Financial Derivatives. This is one of the important courses in the finance domain. As the name tells you that we are limiting our discussion only to the derivatives which are in the finance domain. Let's look at the course details. We have the 6 modules which will be covering the basics of derivatives. Now, what are derivatives and why it is relevant? Derivatives are the financial products whose value is determined by another set of assets. The cash flows generated by another set of assets will decide the value of these particular financial instruments. So, for example, we can see that if there is a commodity which is sugar, the sugar prices keep fluctuating over the period, or take a stock prices change every day, every moment, and the prices change and the prices are settled at the end of the day. If I write a contract on this particular stock and the change in the price of the stock will decide what will be the price of my contract. So that means this particular instrument which is written today based on the fluctuations of the price of this particular share is called a derivative instrument. The word derive is used to title this particular instrument because the value of this instrument is derived from the value of the cash flows generated by another asset. Now, what is the use of these particular instruments? As you can see that the instrument is dependent upon the underlying another stock or a commodity. If there is a fluctuation of 2%, there will be a larger fluctuation in this instrument value. And this is exactly is the reason the financial derivatives are mushroomed in the recent time. Now you can say that it is a risky instrument, whereas the fluctuation of the underlying is very small compared to the fluctuation of the derivative instruments. We'll be looking at in detail, but as an overview, let's look at how many modules are in this particular course. So we can see that there are 6 modules. First is the introduction. Obviously, it's new terminology which will be used here. Mechanics of forwards, mechanics of futures. There is a difference between forwards and futures. There are different types of futures and also swaps. We will be going through those also in detail. Another instrument which is very important, which is the module number 5, which is options. Options, as the name says, it gives options in the derivatives. And lastly, we need to price these options, and there are various trading strategies. So today we are going to talk about the introduction to the derivatives. Just look at the language which the derivative people use, and you can see that I am long 22,000 deltas in Microsoft. I got a negative gamma, hardly any stock, and all of a sudden near term at the money puts, jumped from 45 to 88% on the settlement news. My position risk went out of control and I had to cover a bunch of short puts at a ridiculous price. Now you might be wondering, what are these words? Don't worry. All these words we'll be learning through this course. And at the end of this particular course, we should be able to make the meaning out of this particular slide. Now what happens is, these are the very risky instruments, and therefore there's one particular joke which you can see that I have decided to hang in for a long term, maybe even all day. Now why is this derivative instrument is so important? And we can see that the volume NSE one day in rupees crores is 360 crores is the volume number of trades which is actually done in the equities, the value of 60 lakh crores, and that is particularly one day, right? And you can see that these are the options, derivative products. You can see the index future, index options, stock futures, stock options, currency futures, currency options, commodity futures, commodity options, interest rate futures, and interest rate options. So we have different products under the derivatives. We'll be seeing that in detail later. What the point of this particular slide is to show you that the amount of value which is traded in a particular day in the equities is 60 lakhs, and you can see that futures is more than that. So you can see that derivative instruments are very important instruments. But before we get into the actual definitions of derivatives, we need to see some of the definitions and some of the terms. So you can see that an asset which has a monetary value in future. So for example, if I am having a 100 rupees note, it's an asset, it's in terms of cash. But does 100 rupee generate cash flow in future? Or suppose you have machinery in a firm, the machinery generates cash flows in future. So these are the assets. So the assets are those whose ownership is lying with you and which has a positive monetary value in future. Liability, obviously, it has a negative monetary value. The term instrument is used to describe either asset or liability. A contract is an enforceable legal agreement, and a security is tradable instrument representing a claim of group of assets. So what is a derivative contract? Derivative contract, as you see that it's an enforceable agreement, legally enforceable agreement, whose value is derived from, as we discussed earlier, from the underlying asset. And then underlying asset can be commodity, precious metal, currency, bond, stock, or indices or commodities or stock. So you can see that most of the instruments which are titled are forwards, futures, options, and swaps. As we discussed earlier also, that derivatives are more riskier than the underlying assets. So it might give you more benefits, but we also you should be very, very careful, because these are like jet engines. It goes faster, but also the crashes will be quite riskier. There are certain definitions which are given by the Securities Contract Act 1956, which talk about what security should include and what a contract should include. Important concepts in financial and derivative market are risk preference. Now, the derivative instruments which are very risky, the use of these particular instruments depend upon what is the risk preference of a particular investor in that domain. Now, if you are willing to take more risk, you will be taking positions in the derivative instruments. Underlying has a small fluctuation, and the derivative instrument will be having a larger fluctuation. Since your risk appetite is more, you would like to go for a derivative instrument. Something called short selling. Short selling means normally we see that in the trade we normally buy first and then sell. In this particular case, there is an option to have a short sell. That means you sell first and buy later, and how actually this mechanism happens we'll see over the course. Repurchase agreements. Return and risk which we have seen is normally as a finance basic concept which is also available, but when we see that the risk is quite differently treated here. And market efficiency and theoretic value. The determination of the prices is the prices of the derivative contract also is determined by the efficient market hypothesis. We can also see that the markets which are there. So we can see that spot market and future market. Something happening today, let's say 100 is the price of share A, and the price might go to 105 tomorrow. That is what the future price of this particular. So we can use the word spot and future for denoting what is happening for a particular asset on a particular day, that is today, that is a spot price, and what happens to that particular asset tomorrow, that is a future price. Now, if you see the determination of price is done normally by principles of arbitrage. Now, we have seen the arbitrage. I will be looking at these particular examples in detail in due course of time. As is the case with other markets, in this market also we see that there are different players in this market. The players are hedgers, speculators, and arbitrageurs. Now, as one can imagine, the hedgers are those people who are having basic exposure to the asset, the underlying asset. So, for example, a firm owns an asset worth 1 crore and it generates the products which are to be delivered in future. Now, since these are to be sold, there is a basic exposure for this company to deliver those goods. Now, the prices might change over the period during this time. Now, if the prices change and the price, for example, from 100 it goes to 95, and if you don't take any position to hedge this particular asset, then you will see that you will get only 95 tomorrow. If the price is 100, spot price is 100 today, and the price goes to 110 tomorrow, you will be happy in that situation because for the same assets of 100, you will be able to sell 110. But these are uncertain. So you do not know for sure that whether the future is going to turn up 95 or it is going to turn up 110. And this is the exact reason for which we need to use the derivative instruments to hedge this kind of risk. So for example, in this case, there is a loss of 5, and in this case, there is a gain of 10. Can you do something to ensure that we will make a profit of plus 10 in future by doing something today? And that is what exactly the hedgers do. Hedging is that principle which mitigates the risk in future by taking positions today in derivatives market. So one can see the derivatives are used to hedge or to mitigate the risk which inherent in the instrument or the underlying. So the instrument which is worth 100 today might go to 95 tomorrow, or 100 today it might go to 110 tomorrow. So if you want to ensure that the value is fixed at a particular point and you are exposed to the underlying, as a firm, you need to hedge this particular. So we can see that the first category of the traders which are there, those people who are actually having a risk exposure on the underlying. The second one, obviously, the speculators. Speculators are not exposed to underlyings, but they would like to take positions in these instruments to make a profit. And as we have seen in many previous courses, the speculators actually give the liquidity to these markets. In the event the speculators are not there, we will find that the trading mechanism which happens on the exchanges will become inefficient. And we see that for pricing the derivatives, we need to have the efficient markets. The last one is the arbitrages. Now, arbitrageurs are like opportunists. They look at the comparison between two markets and take the positions accordingly to make the benefit. So, buy from market where the prices are low and sell it in the market where the prices are high. Now we are looking at, see, this is the first an overview of the course. So we'll be seeing all the products in detail, but we can see that basically there are derivative instruments, and we can see that forwards and futures and option contracts. So we have basically two classification of classification into two parts. One is forwards and futures, and the other one is the options and swaps. Now we can look at what is the difference between forwards and future in due course. But then forwards is the over the counter product, and this is traded on the exchange. All right. So as we have seen, the derivative instruments are riskier than the underlying asset. The purpose of using the derivative instrument is to hedge the risk, to mitigate the risk the underlying asset has in future. So in the spot market, the uncertainty prevails. Derivative market ensures that the uncertainty in the spot market is mitigated by properly taking positions into hedging markets. Now, secondly, we saw that forwards and futures contracts are instruments under the derivatives, which are the contracts for the future, but there is no option of changing the contract. In the options, the option is given whether to execute or not, and therefore these are the options. Both are dealing with the future. Now we can see in the derivatives, forwards and futures and options, the positions which can be taken are long and short. However, in the options, we are having two more products, which is calls and puts, and in these you can again take long and short, long and short. Right. Since this particular course uses different terminology, we'll go slow to understand each one of them separately. In the case of forwards and futures, the long position means that you are expecting the price of the underlying to go up in future. That is your expectation. If you are expecting the price of the underlying to go up in future, you would like to take a position of long in forwards on those instruments. So the underlying in the spot market has an instrument in the forward market or futures market, and you expect that the price of the underlying in the spot market is going to go up in future, that is the expectation, then you would like to take a long position in forwards or future markets on those instruments. Similarly, as you can see that the name suggests short position. The short position will be taken when you expect the price of the underlying is going to go down in future, then you would like to take a position of short in forwards or futures market. A similar terminology, but we can see that the calls and puts are two products under the options. Calls gives an option to buy the underlying in future or not at a determined price, predetermined price. There is an option whether you like, if it is beneficial for you, you would like to buy or deliver the instrument. On the other hand, the puts in the long is an option to execute the option, exercise the option or not, based upon what is the position of the underlying in the spot market. We'll see with the examples all these details. This is just an overview. So what we are looking at is forwards and futures is one class of category where there is no option to not to exercise, whereas in the options we have option to exercise or not, depending upon what happens to the underlying in this spot market. So as we have seen, the positions of long and short are for the same contract. One party will be long, since the another party signs the same contract, the another party will be short. So for example, if you take a long position in the forwards market, expecting that the underlying price will go up in future, if you take the long position, the opposite party which is signing this contract will be taking the short position. Similarly, if you are taking short position in the derivative instrument, the counterparty which is signing this agreement will be taking the long position in the same contract. So the usage of long and short is determined by who is taking that particular position. So when we are talking about a firm taking a position, we normally stick to from the firm's point of sight, not from the dealer's point of view. Similarly, you can see that there is a long call and short call. So if the firm takes a long call, then the party which is agreeing to sign this contract is taking the short call in the same contract. Similarly, if short call is taken by the firm, then the opposing the counterparty is taking long position in the call. We are going to see the details, the payoffs of these particular instruments, but what we are particularly doing today is trying to understand the terminology. So we see that derivative instruments can be classified broadly into two terms, forwards and options. In the forward market, we can see that the terminology which is used is short, long and short. As we know that long position in the forward market or futures market is taken when you expect the price of the underlying to go up in future. You take a short position in the forward or futures market, you expect the price of the underlying goes down in the future. Similarly, you can see that in the calls, as the name says, there is an option whether to exercise or not. Here you don't have an option to exercise or not. Whatever happens, you need to execute this at the given price in future. Whereas in this, you may retire without executing the contract. And that is why this is an option. This is a very beautiful instrument, but also see that every instrument, if there is an option, there is a cost involved into it. And how actually these prices are determined, we'll be seeing in the module number 5. Now we can see that the forward contract, as I earlier said, that it is a over-the-counter product. So the forward market is between two firms, where two firms are saying that, okay, I have certain exposure to the underlying, I need to take a position of long, and find an alternate party which is known to you and has a short position in the same underlying. These two parties come together and sign the contract, and that is done in the forward market. So it is between these two parties only, over the counter market. And what does that mean? Actually, it is no exchange involved, no regulator is involved in this particular contract. So we can see that forwards are tailored according to the needs of the parties involved to take positions in future. On the other hand, in the futures market, we see that there is a need of an exchange. When you want to take as a firm a position in futures market, you do not necessarily know the counterparty which is signing this agreement, because there is an exchange in between to coordinate this activity, and exchange does this for a cost. The another difference of this exchange product is that these products are standardized. So it means that the features of the contracts are pre-decided and fixed. But in the case of forwards, you see that the contract can vary depending upon the two parties involved. So you have seen two differences: forwards, over the counter market; futures, exchange traded. Forward markets, the terms are decided by the parties signing this agreement; futures, standardized products. Now there is some terminology. As I said, that we have seen the terminology which is underlying. I think by now you know what is the meaning of underlying. Just to reiterate, derivative is a contract legally enforceable whose value is derived from the fluctuation of the prices of the underlying asset, some other asset, index, commodity, or stock, or weather as well. So we have seen that there are weather derivatives. As the weather changes, the value of the contract which is signed also changes. So that is what we have seen, underlying asset. The future date on which the transaction happens is called maturity or expiration date. You need to remember these terms, because once we go ahead in the course, these terms will be used. The predetermined price at which the trade takes place is forward contract price. Now, what is the difference between the forward and spot market? So we can see that in the settlement for the forward market, the date is set in the future. So you can see that in the forward markets, the settlement happens in future. Spot market and future, in the future we are having this. The spot market, the settlement date is present. Right? It happens at the same time when you buy, and so buying and selling happens, buy and sale happens together. However, in the case of this is foreign markets, the buying or selling happens today, and opposite, that is selling or buying, happens future. The contract price is determined today. The price in the spot market varies of the underlying. However, the contract price remains same. The contract price, as it is a contract, it doesn't change. So, having said that, there is a difference between the spot market and the futures market, we can see that the settlement date for the spot markets is within a couple of days, or for the practical purposes it's considered to be present, and the prices fluctuate over the period for the spot market. Whereas for the forward market, we can see that the contract price is fixed today. The decision to buy the underlying or sell the underlying is taken today, and the closure of this particular forward contract and future contract happens in future, but at the same contract price which is signed on the spot date. Secondly, you need to settle the buying agreement with the selling agreement and selling agreement with the buying agreement. We'll be seeing this mechanism in detail next class. This particular course entails a lot of new terminology, so we need to go slow in this course to begin with, and later on when we look at the various case studies and the application of the same principles and concepts to hedge or mitigate the risk of the underlying. So what this course we have learned so far, to summarize, we have looked at derivatives are a legal instrument whose value is determined by the fluctuation of the underlying assets. The underlying asset can be stock, index, commodity, currency, or some esoteric products like weather derivatives. We have seen secondly that derivatives are classified into two parts, the forwards and futures on one hand and the options on the other hand. In the forwards and futures, the settlement happens at a future date, the contract price is decided today, and there is no option not to exercise. In the case of the options market, the contract price, called exercise price in this case of options, is decided today. The options are exercised or not depending upon the fluctuation or the value of the underlying asset. It is left to the buyer of this contract. So option gives you whether to exercise or not option choice. The choice is there for you whether to exercise or not. The use of derivatives is to mitigate the risk, but we have seen also that the derivatives are very risky instruments. The underlying price varies by 5%. It is possible that the derivative instrument price might fluctuate by 7 or 8%. So it is riskier than the underlying asset. Of course, there are benefits of this, and if you know how to use the derivative instruments, you will be able to mitigate the risk of the underlying asset. And we are going to see this in detail in coming lectures. Thank you.